We are not saying you should use one indicator or another, or even any indicators at all. But people have asked us, they look at the list of indicators on the charts and they want to know how some people have used them in the past. So that is kind of the point of these indicator labs. So today we're going to talk about this one in particular. We'll talk about the background and construction of this family of indicators called the directional movement indicators, and then we'll go over the trading approaches that people have used to utilize them to try to make some money. All right, so this is a group of indicators. It's not just one, it's a whole group of them, and they were developed by a fellow named J. Wells Wilder in 1978 in a self-published book, New Concepts in Technical Trading System. Mr. Wilder was a very prolific indicator developer. He was trained as an electrical engineer, but then moved into commodities trading. It was during his time trading commodities, he developed not only these, but a lot of other popular indicators you might have heard of: the RSI, Relative Strength Index, the Commodity Selection Index, the Parabolic Stop and Reverse, among many others. So very prolific. He designed this set to help him trade trends, and he put them together to build a trend following trading system. So we will go over what that system is coming up here in just a second. So what are the indicators that make up this family? The first one is called DI positive, or positive directional movement. The second one is DI negative, or negative directional movement, something called DX, net directional movement, and ADX, called average directional movement. There's also another offshoot called ADXR, which we'll talk about too. So what is directional movement? In other words, what concept is these indicators based on? And you got to start off with his definition of directional movement. The basic increment of directional movement, according to Mr. Wilder, is the largest part of today's range that is outside of yesterday's range. So we'll do several examples to get the concept clear. So if this is yesterday's range and this is today's range, well, is there any part of today's range that is outside of yesterday's range? Yep, this part right here, it's up. So this day would be considered to have a positive directional movement increment. Let's go to the figure on the upper right. So if this is yesterday's range and this is today's range, then is there any part of today's range that is outside of yesterday's range? Yes, there is. It's this part here. It's down. So this day would be considered to have negative directional movement. Now let's go down to the lower left. This is one step beyond that. That's yesterday's range and this is today's range. Now we have two parts of today's range that is outside of yesterday's range. But remember, it is the largest part of today's range that is outside of yesterday's range. So this is outside of yesterday's range, but so is this. This is bigger than this. So it was up. So that day considered to have a positive directional movement increment. And then finally, on this day, we have this part is outside of yesterday's range. This part is outside of yesterday's range, but we want the largest part, which was here. It was down. So this day is considered to have a negative directional movement increment. That begs the question, of course, how about inside days? And inside days is where that is yesterday's range. This is today's range. In other words, all of today's range is inside yesterday's range, hence the name inside day. They do not have directional movement at all. Now, obviously, to be meaningful, you have to express directional movement as a function of range. So let's say that you had $1 of directional movement on a stock that usually moves around 25 points a day. Okay, that's one thing. And then consider you have another stock with a $1 directional movement increment a day, but it only moves around generally about 50 cents a day. Obviously, it is a much bigger deal for that second stock. So you have to express the directional movement increment as a function of the range. And the range measure that Mr. Wilder used is called true range. Okay, true range is the greatest of the current high minus the current low, the absolute value of the current high less the previous low, or the average, the absolute value of the current low less the previous low. All this does is kind of explain it like this. So if, let me put a different pen color here, and we'll try to explain it a little bit differently too. So let's say that we have two stocks that are the same price, A and B, and this is today's range on A, this is today's range on B, okay? You would say, just looking at this, that A has a bigger range. But what happens if A closed here yesterday, B closed down here, gapped up, and then closed there? In one day, B actually has a greater range than A because you got to consider gaps. So that's all true range does. It's basically considering gap moves. So B actually has a greater true range than A. All right, so true directional movement then is the difference between the positive directional movement increments and the negative directional movement increments. dx is a measure of that net directional movement. Now, Mr. Wilder scaled dx, so it has a value between 0 and 100. The higher the dx, the more directional the movement, all right? So the higher the number, the more the stock or index is trending, all right? Now, if you just looked at dx by itself, and that's all you saw was the dx number, you could tell if a stock was trending perhaps, but you wouldn't know the direction of the trend because all dx is telling us is the direction, is the strength of the trend, not the direction, okay? So it's a measure of trend strength, but not direction. Now, in practice, dx is basically very wiggly. So we smooth it down. The smooth version of dx rather, is called ADX. Okay. Stocks or indices are considered to be trending if their ADX generally is greater than 25. And again, the value of the ADX does not tell you the direction of the trend, only its intensity. So let's take a look. All right. So this is obviously trending higher. You can see that ADX is over 40. Here's another where ADX is exactly the same number, over 40, but the trend is lower. So this just tells you that ADX is telling you the direction, rather the intensity of the trend, not its direction, okay? Now, there is another measure that if you use the Market Edge reports on our website or on Street Smart Edge called ADXR. So let me just explain that one. Okay, ADXR is simply an average value of ADX over a certain period of time. So it would be like ADX, 20 days ago plus ADX now divided by 2. That would be ADXR. And ADXR, if its value is greater than about 20, the stock is generally considered to be trendy. Now, just knowing about ADX is already a useful tool if you're looking for stocks in certain conditions, right? If you're looking for nicely trending stocks, it is a way to find them. So let's go over to our trading platform, Street Smart Edge, just to show you, just knowing what you do now, how you might use it. All right, so we could just go to our screener and we could build ourselves a new screen. And we could go to technicals. So if you just want strongly trending stocks, all right, you could go ahead and take a look at ADX. All right. So let's say you want strongly trending stocks, maybe set it greater than 50, for instance. Well, let's do 40 because that was on the chart. All right. So this should give you a list of stocks that are trending. We'll just take a look at a couple of them, and we'll also see it might not matter what the direction is. All right, so obviously high IDX, that stock is trending. So if you want to know where the action is, looking for stocks with high ADXs, okay, can help you out. Okay. Question: are you using a daily chart? I am for this example. You can use ADX on intraday charts too. It would just it would be the you know, you would do the calculations based on 5-minute periods as opposed to the daily. But yeah, you can use them on intraday charts as well. All right, now you can modify this. Let's say you just want uptrending stocks. All right. So what you could do is simply add another filter that would give you a stock, you know, that is probably up trading. Well, like the 15-day moving average, for instance, is greater than the 50-day moving average. That would give you an uptrending stock. So then you'd have high uptrending stocks. Let me do that for you. All right, so now these will just be highly trending, uptrending stocks. If you wanted highly trending down trending stocks, you could just do it this way. Okay, so this is high ADX stocks. Which are downtrending because the 15-day is less than the 50. Right? So there you go. So you can use that then just to find stocks that are trending in either direction with just a couple of clicks. However, there's something more you can do with just the ADX. Let's say you're looking for stocks that are relatively range bound. Well, if it's range bound, would you think the ADX would be high or low? It'd be low, right? So what we could do is go back to our screener. And we could go back to the criteria and just say we want stocks with an ADX, let's say below 12. Below 12, Lee, less than 12. All right, this might give us stocks that are relatively range bound. There you go, right? There's a stock in a nice trading range for you. So you could actually draw in the range if you wanted. So if you want to know how to find stocks that are range bound, again, you can use ADX. So there's lots of things you can do just by understanding ADX. Okay, now parameters of the indicator. Most people do use Mr. Wilder's default of 14 periods. So I say periods because as the question already came in, on a daily chart, that would be 14 days. On an hourly chart, it would be 14 hours. All right. It doesn't matter what you choose. A lot of people use 20 for the ADX and all the other indicators because there's 20 days in a month. 14 is 1 day shy than 3 weeks. Actually, Mr. Wilder did not choose it because it is just less than 3 weeks. Mr. Wilder, believe it or not, was a great believer in lunar months, and 14 is half a lunar month of 28 days. That's where he got the default from. But since you want to maybe use the same parameters that other people are using, so you have the benefit of self-fulfillment on some of these indicators, maybe you want to stick with the default. Whether you do or not, though, what you should do, okay, is make sure that for all of the indicators that the default is the same. Okay. All right, so now let me show you how to put these on a chart. So we're going to go to Studies, View All Studies. It's under Trend, Directional Movement Indicators. Okay. All right, so blue doesn't show up very well. I'm going to change that to yellow for ADX. Okay. Again, most people do not show DX, so I'm not going to put it on there. Okay. All right, so again, notice I have them set. I want to set all of the parameters to the same look back period, 14. Okay, again, you could make them 20, but there you go. So we're just going to put these on the chart then. And now you have all the indicators on there. All right. So we have a question. It could be useful for spreads and straddles to determine if stocks are range bound. That's correct. A lot of people who like to trade ranges for whatever reason, covered calls, straddles, strangles, it is a way certainly to do it. That's for sure. All right. Now, let's go over, though, as I said, it's a trend following system. Let's go over how Mr. Wilder actually set up the system. Okay. There's different parts to it. So the first is to go long in a trend following manner. You're going to look for the positive DI line, which is generally green, to cross above the negative DI line, which is generally red. Why would that be a signal? Well, just think about it. What it means is that the positive directional movements are greater than the negative directional movements, right? Which means the stock is probably strengthening, all right? So that is the first part of the signal, is when positive DI crosses negative DI from below to above. However, Mr. Wilder found that when he just used that, he often got whipsawed sometimes, because what you'd have is you'd have a big up day, and then like a failed breakout, for instance, then it would come back down, and eventually this would cross back over. All right. So he put in, to keep from getting whipsawed, he basically put another rule in. The rule was what he called the extreme point rule. So the extreme point is when the positive DI line crosses from below to above the negative DI line, you look for the high of that day. That is considered the extreme point. And you do not buy until that high is exceeded. So on this chart, we did not take out that high the first day after we got the signal, but we did get it the second day. So here would have been your entry. Okay. As you might suspect, a short sale signal, or a signal just to sell out of your long, is when the negative DI line crosses above the positive DI line. What does that mean? What is going on? Okay. What is going on is that the negative directional movements are now more frequent and bigger than the positive ones. So that means the stock is probably weakening. So the first thing you do is you look for the cross. So here was the cross. But again, to keep from getting whipsawed, you use an extreme point rule to enter on the short side. You look at the low of the day that the DI lines crossed, and you do not go short until you take out that low, which was on this day here. And that is your entry on the short side. All right, if that is how you get into a trade using this system, how do you get out? Well, there's a couple of methods. The first method is you look for the lines to cross the other way. All right, so we were we had the nice cross of the line where positive DI, crossed basically here. That was our entry. And now we're watching the lines and it crossed back down below DI negative here. But that is not enough because sometimes you get a real quick pullback, which doesn't destroy the trend. So Mr. Wilder used the extreme point rule to get out as well. So the extreme point rule to get out of a position that you went into as a trend following long trade, you look for the day, the negative DI line crosses above the positive one, you look at the low of that day, and you do not exit until it's taken out, which would have been this day here. And sometimes that'll keep you from getting wiggled out a little bit. All right, as you might suspect, the signal to get out of a short is the opposite. So here was the entry into the short as negative DI crossed positive DI. That was the extreme point. You would have entered here because you took out the low of that day. And now here's where the negative DI line crosses down below, or the green line crosses above, same thing. You look for the high of that day to be exceeded before you get out of the short, which happened this day and you got exit. So you did have another winning trade there. Okay. But there is another way that you can modify the system just a little bit. So what happens, I'll just ask a rhetorical question. What happens if ADX has been rising and then it's the ADX now has been rising, but then it starts going down a little bit? Well, ADX is a trend strength indicator, right? So if it got a lower value than it had a few days ago, that means the trend is weakening. Now, just because the trend is weakening doesn't mean it has to reverse, but it can mean that, right? So here is a modification of the original method. So you're in your trade when, we crossed here, all right, there's our in, we're in the trade on the long side, it's going very nicely. We are also monitoring the ADX line. Here, it starts trending down. So the trend is weakening at this place. Now, you don't have to get out of your full position, and most people don't, but you would take a little off of the table because it is possible, okay, that you just have a little bit of a pullback and the stock turns up again and ADX turns back up. All right. If that happens and the DI lines don't cross, then you can re-enter the portion that you sold. But notice here, that didn't happen, right? We went down, it weakened ADX, so we took off a little bit, and then we got out of the rest of the position when we got the cross, and then we took out the extreme point, okay? So you can use a partial entry and then a partial exit rather, and then a full exit if you actually get the cross. What you got to watch out for though is if ADX turns back up and you already had the cross, then you would be out anyway. All right. So that's it. That's all there is to it. So let's go over the questions. ADX is a leading or lagging indicator. Well, it's lagging. Most technical indicators are lagging. The only one that's really leading is pivot points because it attempts to predict the next day's intraday support and resistance levels. But most, I would say all trend following indicators are lagging. The only way that you can use a lagging indicator as a leading indicator is with momentum indicators, like the RSI, for instance. So if you see a stock that does this, and you're watching the RSI, and it does this, it didn't confirm that high, that is a leading indication that that might be the high for a while. So that's called a divergence. So a divergence with a momentum indicator maybe can be considered leading, and pivot points are leading, but pretty much all the other ones are lagging. Okay, where do we find the PDF for the talk? You can go to the page that you're on, go up to the resources tab, okay, and just click on that, and then you'll get the list of the different subject matter groups, and go to technical analysis, and then you'll get the PDF. I have a question, how does this stack up against %K and %D stochastics? They're totally different. So stochastics is, number one, is banded, right? It can only be between 0 and 100. These are not banded. DX is banded, but these other indicators aren't. Also, the ADX is not trying to tell you if something is overbought or oversold. It's just a measure of trend strength, where stochastics are trying to give you, stochastics are an indicator trying to tell you overbought or oversold. Using charts where there is a crossover, but ADX doesn't go below 25. Is there an intuitive explanation for this? Well, it could be if you had a really strong reversal, you know, it's possible. Also, though, if it is a very narrow pullback, you can get that as well. I mean, if you know, if something, go back to the chart. So I don't know if I have an example, but let's say the stock goes up, okay, it has a pretty good pullback, but it recovers really quickly. You might see the crossover, but if that happens really quick, ADX might not go down that fast. That's probably the explanation also. All right, any other questions? Takes about 30 seconds from the time that you send them in before I see them, so I'll wait here just a second. So is a document mentioned for settings under the resources? Yes, that'll give you the PDF for this. Oh, if you mean the Word document with all the symbols, no, that's not there. But the PDFs for all these indicator labs are there. All right, I guess that's it for the questions. So thank you very much. Good luck with your trading. You can put this on your charts to see if you like it or not. And there you go. How does volume figure into this? One last question. Well, volume is not in the formulas at all. So volume does not go into how those indicators are calculated. How you would use volume is, though, if you had a cross and you took out the extreme point on higher than average volume, that would be a further confirmation. Okie dokie then. So thanks a lot. Is there a way to determine a target when using charts indicators? Not on indicators. They won't give you a target. Some chart patterns, though, can give you targets. So most targets are set, technical targets are set with chart patterns as opposed to indicators. And if you take the course that we give called profit taking, I don't give that one, but my colleagues do from time to time. That will give you some target setting methods based on chart formation. Okay, I guess we got them all now. So thanks for your engagement. Take care, and check the schedule for what's coming up more under Schwab Live Daily.